Hello, Theo. Nice to be here. I hope you're doing great.
Absolutely fantastic. Vincenzo already sends hello, Jens. So special topic today, right?
I hope so. So, well, today we have something we call a bank holiday over here in Germany. So it's a very slow day.
Okay.
Yeah, but well, what shall I say? So it's markets are open, and so it's
exactly.
it's better to focus today, I'd say. So
yeah, exactly. So I wish you to have a nice session.
I can already share my screen. I've just seen it. So yes, perfect. Yes, so have a nice weekend and enjoy yourself. Talk to you again next week.
Absolutely. Thank you so much.
And please don't short Nvidia.
Okay, I would stay away. I would stay away.
That's a very good idea. So just have a look at the chart and you will see, well, there's plenty of market participants potentially got burned.
Okay. All right.
Okay. So hello, and I welcome you to today's trading spotlight together here with Admirals. It's Friday. It's the 19th of May, 2023. I just can see it here. Mark just said it's the same in France. It's a bank holiday. So I'm not really sure about the day yesterday, but yesterday, well, shops were closed, and today there's something in Germany we call this a Brückentag. And as a trader, you don't know what this is, so you trade when the markets are open. But so when you're working as an employed, especially, then well, or put it differently. So for example, in school, my son, he is at home now from I think Tuesday on, or no, Wednesday. So Tuesday was the last day he was in school. So like they had some kind of study day or something like that on a Wednesday. Then yesterday we had a bank holiday. Today we take another bank holiday. Then there's the weekend. So yeah, fun to be a teacher, let's say. But today we want to focus here on a topic which is still very, very hot. We want to focus on inflation. And I want to guide you through some thoughts on this. And it's very interesting right now what we get to see, in fact. So you probably have seen it. We've broken out in the NASDAQ to new yearly highs. We've broken out in the S&P 500 to new yearly highs. And so that's very interesting to note, because now you might say, well, sure, makes sense, because inflation cools down and the Fed is potentially willing to ease in the second half of the year. But, and this is the thing, expectations around this easing or cutting rates in the second half of 2023 are coming down right now. So these expectations are coming down, means that market participants are more and more of the opinion that probably there will be a cut, yes, but it won't be 75 basis points based on the Fed Watch tool. We want to have a look at this, but it's more likely it will be some kind of 25, probably 50 basis points. And that's very interesting because this is usually an environment in which you don't see such bullish and breakouts or runs higher in equities, especially yield sensitive stocks, for example, like tech stocks are. And this is very interesting to note right here. So probably markets are already anticipating that this just won't happen, that there won't be such a very, let's call it, restrictive approach, or one which is closer to what the Fed already communicated, which is interesting because there's a huge divergence between what the Fed told us she will do over the course of the year 2023 and what market participants think the Fed will do. And there's a huge divergence. We want to look at this, and inflation comes in here at a very important, or it's very, very important topic in this regard. And especially here, we want to have a view on and look at. So I already mentioned NASDAQ 100. I mentioned the S&P 500. Very important. Everything I present to you today is for educational purposes only. So this is very, very important in this regard. if I formulate a trade hypothesis, we formulate a game plan. I give you some idea on how I play the market. 1 second. Okay. If I formulate a trade set up something like that, please make sure that you understand that there's risk involved when trading CFDs, respectively leverage products in general. And in this regard, also please understand that this is educational for educational purposes only. So it's not trading advice or financial advice in general. But if you take a trade, please make sure you understand that there's risks involved, especially when trading leverage products, and that you take full responsibility on potential losses which might happen here in this regard. Full risk disclaimer can be reviewed here, can be found on the website admiralmarkets.com. I don't need to introduce Admirals any further. I think Theo did already an awesome job here in this regard. But we want to focus here on today's topic, inflation. And first of all, because before we start, we wanna make sure that we are all on the same page from a theoretical standpoint, and then use this knowledge and transform it into a potential trade hypothesis. So first of all, what is inflation? In economics, inflation is a general increase in the price of goods and services in an economy. So if prices rise, usually you say inflation is picking up. And obviously, what you can see, and this is what inflation means then, that each unit of a currency buys fewer goods and services. And that being said, inflation erodes, that's what is meant by that, erodes the purchasing power of a bond's futures cash flow. And one second, I'll be back in a Here I am back again. So you probably have heard a dog barking in the background. So we have a new family member. So it's a puppy, and my kids are right now very, very enthusiastic, let's say, about this. So inflation erodes purchasing power of a bond's future cash flow. To bring this back here to yields in this regard. What you see here is, simply speaking, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand this higher yield to compensate for inflation risks. So that being said, you probably have already seen that when looking at 10-year yields, for example, or 2-year yields, for example, the Fed hiking rates now for something like one and a half years, something like that, started, I think, in late 2021, hiking rates into the push higher in inflation, which doesn't come as a surprise. I mentioned this several times in the past, and I will mention it here once again. So rising inflation is what we had to see, given that we locked down economies. We told people, stay at home, stay silent, don't come out. We have to fight the virus. Well, don't smile, don't bring up science here, and don't come up with like, well, does it make sense or something like that. We don't want to discuss that here. It's a virus. Yes, I see that point, but again, this is not the topic of the webinar today. But what happened was that this lockdown and the handout of stimulus checks here for people, so handing out money, which is chasing fewer goods. Why? Well, because if you lock down an economy and don't produce anything, well, obviously, then, and it's not just that you're not producing it right now, but you have to get the machine, the engine started all over again, and this takes time. So it takes time to produce the same amount of goods as happened in the past. There's in a manufacturing side, for example, you need some parts for building cars, whatever it might be, and it just takes time. So you have fewer goods, and you have more money chasing the fewer goods. Well, this is one-on-one economy or economics in this case. If you studied economics, well, what will happen is naturally you will see see inflation picking up. Interesting enough, if you carefully listened to this course in university, I'm not even sure if you really need to follow a course here in university on economics. Probably just need to be part of this society, or probably you have to had a job or some kind of a traineeship with, I don't know, whatever, manufacturing services, whatever it might be, or whatever it might be. Well, it's usually, if you have fewer goods, if you have more money chasing fewer goods, well, you see prices rising. The funny thing is that especially central bankers around the Fed, ECB, didn't see that coming. You can't really believe that they said that, but they said so. You can find the remarks and quotes here on Google. And this is exactly what we got to see. So we've got to see this pickup in inflation. It's not the classic pickup in inflation. Once you see market participants being kind of, let's say, and probably head over here to this chart. So you can see that here. The blue line in this regard is the inflation rate, and you have producer prices here as a black dotted line. In this regard, you can see that here, by the way. So 2022, so in the middle somewhere is 2021. That was COVID. There was the pullback, let's say, and then we saw the pickup in prices, and especially here even earlier in producer prices, which is then where you see producers forwarding their higher costs of creating good at XYZ, and then they will forward it to the consumer in this case, and then the blue line starts to pick up too. We have seen that coming already from 2021 onwards. So I have a very good friend, best friend of mine. He's a painter, well, he comes and tells me, well, we see massive increase in prices when it comes to paint here, and it's not just in regards to painting walls, but it's also to buying houses. So like the goods you need, it's like we could see that coming. Fortunately enough, politicians found another reason, and they called this Putinflation. So it was because of the invasion of the Ukraine by Russia in early 2022, when inflation, by the way, nearly peaked out already. So we've seen already a massive increase here. And the last potential spike higher probably was due to, in this case, commodity prices massively rising. Probably, but the main driver here was certainly not the invasion of Ukraine by Russia. But it will make things easy here. And as a politician, you just say, well, this is the reason why inflation picked up. Obviously, it's not the case. But whatever it might have been, I told you what was the reason for that. The thing is that you saw this massive increase in inflation. And how you fight this? Well, and then coming back here to this, you hike rates to a level where you make sure that inflation is not getting out of control in this regard. And this is exactly what we got to see in a very aggressive fashion over the course of the year 2022. I'm sorry, yeah, 23, 22. So last year. The thing is that higher yields in this regard mean there's less liquidity available, which was not just chasing fewer goods and pushing prices for goods you consume on a daily basis, for example, but also rising or pushing prices higher when it comes to asset prices, for example, creating massive asset bubbles. And you just take out this air out of this cycle, and this is exactly what drove prices lower. Now, what you see, a stock exchange, or in general, a stock is not showing what's the current situation, but it's discounting the future cash flows here. And this is exactly what you get to see then. Once inflation started to top out and coming down already, you now see from June, well, or it wasn't September, October, something like that. We saw a clear bottoming out process in equities, for example, NASDAQ and so on and so forth. And then from there, we took off. And what the market is right now playing, even though that yields are at the highest level since 2007, shortly before the great financial crisis, what you're now seeing, that the market is already taking off because it expects the Fed to cut rates rather sooner or later, which is nothing more than saying, well, we expect inflation to continue to come in lower over the course of the next months. So the next print we get to see here is in June for May. That will be somewhere in mid-June. I don't know the exact date, but what I can tell you is that the last print we've seen here, this is last Wednesday, 2 weeks ago. No, last Wednesday, 1 week ago, last week, I'm sorry. Last week, Wednesday, the print came in at 4.9%, came in below 5%. And it was I'm not sure, but I think it was the 6th, 7th, 8th, 12th, I don't know, print in a row that inflation came in below the month before. And we continue to see a price push lower there, which is no surprise. We made this a topic here several months earlier in this webinar series. And I told you inflation will come down, that this is a must, in fact. And the reason for that is because I was pointing here to a very interesting correlation. What we did in the past was, or how I came to this conclusion was, well, what we have here now in the black dotted line is an inflation rate, and now the blue line is the US ISM manufacturing price development. So you probably see each month there is this ISM manufacturing, non-manufacturing released, and there's a subcomponent. It's called the prices, or it's also around the employment situation in the manufacturing sector. It's also around orders, new orders in this regard. And I like to, in the current environment at least, have a look at here the price component. And what you see is that if prices come down, and this is something you could have seen coming already here from the second half of 2021 onwards, this top out structure we've seen here, and then this massive deceleration, which already took on momentum here, that was around the highs last year in June, July, once we topped out around 9% inflation rate in the US. I said, well, as you can see here, this black line, in this case inflation, it follows this blue line. It's an early indication of where inflation is headed. And the interesting thing now is that here we saw this rollover and this deceleration, and then from there we saw the top out, and now these two lines start to close this gap, let's say. So this divergence here, which occurred. And now the thing is, the question we have is inflation about to bottom out, let's say? And it's probably that we stay at an elevated level, but that the cool off of inflation, which we've seen here, witnessed over the course of the last 6, 8, 9, 10 months, that this is now about to come to an end, and that we are probably start to, let's say, stabilize. And therefore, let's head over here to trading economics, and this is where I have the charts from, and we want to go over here to inflation rate, indicators, inflation rate, and then go here to United States. Where do you have it? United States, United Kingdom. There's the United States, and then you can see that already. There was a sharp further deceleration, let's say, or cool down in inflation from February to March, and now we start to bottom out somehow around 5%, slightly below that, which is interesting because the current interest rate, the target rate of the Fed, which you can see here. By the way, let me just share some links here in the chat box. So this is Inflation on Trading Economics. I highly recommend this website. I mean, no question about that here on admirals.com, admiralmarkets.com, the website from Admirals, you can find a very great Forex calendar, as you can see here. So via analytics, and there's the Forex calendar, and get all these informations there too. But I like trading economics because it's visually something, it's more appealing, let's say, for me at least. And I really like to share here these CPI, let me call this TE for trading economics. And I also want to share the Fed Watch tool, the link here, so you can rebuild everything I show you here yourself and dig deeper into this. And so very interesting is that the current target rate is 500, 525, while inflation is at 4.9% year on year, which is interesting because now we are at a inflation, how can we say it? An inflation under control environment. That's probably a good way to put it. So inflation seems to be under control again, but we can't be sure that inflation is not picking up again and see a spike higher of, say, in this regard, something like 0.5 a percentage, 0.5% or something like that, and percentage points. That's probably a better way to put it. And we are back above that level. So it's close call, let's say. And we are still in the range now. And the question we have is, can we now say inflation is back under control, especially now with this potential bottoming forming structure we can see here in the ISM manufacturing prices environment, which is a kind of good correlation, I would say. And this is something which is probably also part of the thinking process of Jay Powell, the Fed chairman, which is, by the way, today having a discussion together with Ben Bernanke on monetary policy. It's very interesting to listen to that. It will be around, I think, I'm not sure, but I think 5 p.m. German time, so something like 4 p.m. UK, if I'm not I'm not really sure, but we should keep an eye on that or listen to that, because it could give us some let's call it impulses into the weekly close, given what we've just witnessed in equities, especially, and in this regard in the S&P 500, respectively in the Nasdaq, which just S&P 500 just broke to new yearly highs. The question is, if it's a sustainable move, can we stay there close above this breakout level at yearly highs? Or will the comments from Chairman Powell give us some kind of, let's say, doubts that there will be really a cut process, let's say, rates being cut in the second half by the Fed, which is, by the way, nothing we've seen or listened or could have found in the Fed statement from the last release, which was released 2 weeks ago. So in the on the 3rd of May. So Wednesday, and then 2 weeks ago, 1 week before inflation was released. But coming back now, cooling inflation, is it about to come an end? And what I'm talking about, the Fed here. So I've prepared this already to what to look at. And this is something you don't find. You can find it for free. It's the so-called Fed economic, it's the economic projections. And this is released with the next Fed event on the, let's go back here to, this is, by the way, also a great way to find out when the next Fed will take place. You can play with these buttons here, and you have the 14th of June. This is the next Fed statement, and this is then the moment once these dots you can find here are released once again. And this is a snapshot from the latest economic projections, the economic projections which are released from the Fed, going hand in hand with this rate decision. And what we have here, this is from last year. So you can see here, 15th of June, 2022. And you can just change the date here, going to 23, going to March. And I think, I'm not really sure, but I think it was the 22nd, if I'm not mistaken. Yes, 22nd of March, 2023. And there you have the summary of economic projection. As you scroll a little, that looks very pathological, in my personal opinion. I'm not really reading through this, but what I'm interested in is, where do we stand here with these so-called dots? What do these dots mean? Well, the dots mean nothing more than each dot represents a voting FOMC member. And the question here is, well, where do you see rates at the end of the year here? It's 2023, we're 2024, and so on and so forth. Where do you see it at the end of 2023 in this regard? And then they say, well, we see rates at 500 to 525 basis points or higher. So you can see majority here is 500 to 525, while there's some dots also on the higher end. And there's only one who sees here 475 to 500 basis points. It's interesting because now use this here, 500 to 525, and go to the Fed Watch tool and look where the market is pricing here the rates at the end of the year. You can see 475 to 500, even higher at 450 to 475. So what the market participants tell you here is we don't expect the Fed to stay at these levels, but we think with a majority here of in this regard, by the way, so 11% here, so it's like 12. This is like 90% expect the Fed to cut rates at least once by 25 basis points. It's nearly 90%. And if you read carefully through what the Fed released here and their outlook on the employment situation, on inflation, and so on and so forth, well, you can clearly spot a difference. Yes, we might see a pause right now at the current levels, 500 to 525, after we hiked another 25 basis points earlier this month. But and due to, let's put it that way, due to the tensions in the banking sector, all developments around First Republic and Silicon Valley Bank and Signature Bank and so on and so forth, and PacWest and whatever. Okay, well, but still we pause. It doesn't mean that we are planning to cut rates. While the market is saying we expect you to cut rates because right now the overall economic situation just does not justify keeping rates at this elevated level, especially with inflation cooling down. So this is exactly where we stand right now. And it's very interesting here to see that the market still changed its bias a little, because these columns here, I just changed this this chart earlier here. And let me just see, can I go back? Let me just see, does this work? You see, so I changed this chart, and this is the chart. You can see it here. I changed this chart from the last time. Well, it's 1 month ago or something like that. And you can see here, there we had an increased likelihood. And by the way, so we increased chances here on the right side. So markets starting to think about probably they will stay at this level, and we start to believe what the Fed is telling us. It's very interesting to see that, because there's obviously a massive shift now to the right and more restrictive approach, which should drive equities lower. That the market is not under pressure, given what we've currently witnessing, inflation cooling down, potentially bottoming out, probably picking up slightly, and the market starting to price this in. Again, let's go here again. So looking at this right now, well, what you can see is that the market is starting to become more restrictive and believe a little more that the Fed will probably keep rates at this elevated level, given the overall situation, which is, well, it's not optimal, but it could be worse when looking at the banking sector, probably putting it that way. So right now, we are not really seeing a complete collapse of the whole financial system in the US or the banking sector here. And given that, market participants start to think, well, probably they will keep rates at this level, which is interesting, because now we can use this. We can say, okay, there's an obvious inflation cool off, and it's not cooling off any further or more aggressive, while markets start to think, well, probably they won't cut rates in the second half. Putting this together now brings us to here the markets, and gives the question or respectively brings us here into the spot to decide now. Well, where are we headed? What will we get to see here in this current environment? So is it bullish for equities? Putting this together, I'd say, well, not necessarily. Even though when looking here at the current developments here, especially in the Qs, so respectively in the Nasdaq, you can clearly see that there's a sharp rise higher right now, despite the fact that yields are picking up. And this is interesting, because this is also something I'd say is a sign of relative strength, and I wouldn't short this, even though I think there is an increased likelihood that rather sooner or later there will be some kind of pull-in, and this probably will bring us back here to this trend line in this regard. So probably now we pushed above the August highs 2022. We made this a topic here in the webinars earlier. And so we're not really surprised to see that right now. And probably there will be a pull-in rather sooner or later. probably next week starting, and probably we roll over. Probably we only see a kind of a consolidation, another consolidation, which is would be kind of a strong signal. But combining everything here, I'd say probably we're likelier to pull in to some extent on the downside. But, and this is the thing, even that wouldn't completely negate the bullish outlook for equities in general. So that being said, I have to admit that this is a very strong picture we get right now here from equities in general, and we are likely to continue higher as long as we stay above here these April or Q2, let's call them Q2 lows, which can be found around 12,700. Let me just go back. Yeah, 12,700, round number, 12,750 probably. And we can keep above that level. Well, there will be certainly some kind of pullbacks, but you want to see these pullbacks from a mid to longer term perspective to have a better risk reward for a trade on the upside. And I would say if we get to see it close now above the August highs in the Qs, this is a strong signal. And given the current environment in which we find ourselves, with yields rising while tech stocks continue to outperform the overall market, that's a strong sign, and you don't want to fade this. So probably there will be some kind of, we hit a wall and we're not hitting further. Probably we should probably look over to other indices, which could be of higher interest and risk reward wise more interesting. And then probably I wouldn't now necessarily look at the Qs, respectively the Nasdaq, but I probably look at the S&P 500, which just broke two new, you can see it here, new yearly highs yesterday, with closing above that level. And we have further room to go, because here in this S&P 500, we haven't yet tested the region of the August high. So there's some room to go. And for today, I had a client asking me, "Hey Jens, how do you trade this today?" Or respectively, what do you think? What we need to see to position ourselves for the long side? Well, I would say what I want to see now, right now, we have the Wall Street open. So let's wait and see how things play out here. But let's go here to a lower time frame. You've seen that yesterday here into the close. So we pushed significantly higher after hours, in fact, but closed strong for the day. So in fact, when looking only at the spot market, what you see right now is a gap up. The question is, can we hold the gap? That's the question for today. Probably now within the next, let's say 15, 20, probably 30 minutes, 4 p.m. German time. So this is around 10 a.m. Eastern in this case. Probably we get to see a short flush lower. But if we can hold the gap, the highs from yesterday, and also above, in this case, the pre-market lows here, probably even turn higher and hold above these after hour highs here, respectively, the pre-market highs, which can be found around 2,213, 15, something like that. And in combination here, you get to see the market internals favoring further gains. What does market internals mean? That's something like we can look at the Volt, for example, here. So this is a Volt, VOLD, that shows you the volume which is flowing into stocks with an uptick. And you have a ratio here and divided by the volume of stocks which which is flowing out, in this case, out of stocks with a downtick. And this is interesting because what you have there is if you have such an environment with stocks holding higher and the Volt is now +3 and higher, which means like the volume flowing into stocks with an uptick is 3 times as high and higher than that, than flowing out of stocks with a downtick. And in combination to that, you have an advanced decline line, which is continuously holding something like 800, 900, 1,000. I think this would be a very strong sign, and we prepare to some extent already today for a run higher here, which means this is an environment which means there's further gains to be expected after this potential breakout we've witnessed yesterday here. That doesn't necessarily mean that the Qs here are not performing well, but I think risk reward wise, and given this overall picture, the spider, respectively here, the S&P 500 is more of interest for us today. And we use all these informations now around inflation to build such a picture. So very short term, but also longer term. Also here, now, for example, you might say, well, what does this mean? Well, it means we have further room to go, but I don't want to chase now. But here, probably I want to wait for this run higher up to the August highs and then a pull in, and then clearly showing that we are holding these former highs around 4150, 4170, and then taking on further momentum and breaking through the August highs, which is, by the way, also a clear bullish sign from an overall perspective, because for sure, this whole sequence of lower highs and lower lows would be broken once we breach and hold above the August highs from 2022. So this would clearly negate the bearish picture we have here since 2022. All based on the hiking cycle from the Fed, and all based on the overall bearish environment we find ourselves in right now due to the Fed hiking rates, combating inflation. Let me just check the questions, by the way. Because it depends. So, well, the thing is, again, it depends on overall what's currently working. Let's put it that way, probably, or what shows relative strength. So, when going back now, we had several webinars in the past already. I'd probably say something. Look up the webinars we did in March and the YouTube channel here from Admirals, probably February, I'm not really sure, but I remember that I mentioned that several times. It was very interesting to note that there was the relative strength to be seen in the Qs. And by the way, we've seen that, we've witnessed it over the course. Now, we broke yesterday 2 new yearly highs in the S&P 500. We did this already last week with the inflation data. And we also held quite solidly here in the Qs already in the past. So, for example, here, once I think that was in the Fed meeting in February, and then we broke 2 new highs, and that was following the Fed in March, and we held higher here. While, for example, in the S&P 500, you can see here was the top out, and then they had this banking stuff and all that things happening here, and we didn't take out these levels till yesterday. So this relative strength, which we could see in tech, made tech way more attractive. And here again, then semiconductors like NVIDIA, like an AMD, for example, also massive breakout in Micron, for example, I think. So you could see that once you track the sector ETFs in this regard, we could have seen that XLK, there was clear risk appetite, market participants betting on rates to come down in the future, which is usually bullish for tech stocks. And so once you have such an environment, which we found ourselves in, tech is, put this in quotation marks, but the place to be. You want to be in tech stocks because they have a more solid chance of performing well on the upside. Now we got a little extended on the upside. It doesn't mean but you have to very like cherry picking here. So like which stocks are very of high interest right now. NVIDIA, for example, I wouldn't go along at the current levels. Let me just show you here why I wouldn't do that. Oh, we don't have, I'm sorry, this is a demo account for a regulation regulatory reasons. So we have a delay here of 50 minutes. So right now there's no chart available, but we went nearly parabolic now in NVIDIA. You don't want to be long here, but once the market pulls in, then probably NVIDIA is an interesting play for a sharper pull in due to this extension on the upside. But coming back now, well, put it differently, that the trade is through. So right now, tech is not the place to be anymore. I think the asset with least resistance on the upside is now to be found here in the S&P with a break higher. And this is exactly what you're pointing to now. Right now, we are focusing on the S&P, but it's not necessarily due to the market breadth or that we are looking here at an overall of a better representation of the overall economy, but it's more because risk reward wise, this seems a more interesting place to be right now than the Nasdaq after the rise higher we've witnessed in the last weeks here. As long as you ask a question. I'm sorry to say that. It sounds quite bluntly, but very interesting. Could you talk about why the DAX and also the CAC 40 here are so high with daily RSI that sky high? And when will they finally go down? It should be hard, I think. The thing is, as long as you ask the question, when will they finally go down? The longer you ask this question, the more parabolic the markets move. This is the same with NVIDIA right now. Same thing. So as long as you ask, hey, when will finally a corrective move start? Well, it starts once you throw in the towel and say, well, probably it's a good reason to go long here. If you plan to start to go long after the market went up too much already, and you still think it can move higher, and this time will be different, just let me know, because this is the perfect moment to short. It's like, I mean, I use you now as an example, but the same is true for my father. My father comes out, like, I told him, hey, did you no, it's the other way around. So he calls me and says, hey, did you see what gold just did? Yes. Wow, this is awesome. Why is that? Well, probably because of this and that reason. And now it's a good time to buy? Nope. Father, now it's a good time to sell, because you asked me this question. Because if he starts as someone who is not really in financial himself, or finance himself, starting to ask questions, people asking me about Bitcoin, for example. So I remember the mother of my wife just asked me. It was years ago, it was 3 years ago, something like, probably was even before COVID. I don't even know. And she asked me, hey, probably it's a good way to buy Bitcoin. Back then, we were around 10,000 or something. And I said, no, I would go short now. I would probably bet on. And why would you do that? Why would you bet on prices falling? Well, because you asked the question why the market should rise here. And this is very interesting. It's also something which by the way, it sounds bluntly right now, but after years in the financial markets and trading markets myself, the moment once I plan to throw in the towel, I really dig deep into myself and I ask myself, hey, what just happened here? So why do you think that? And it's now that this is usually then the time to probably take the opposite trade here in this regard and bet on the opposite. But coming back to your question, so DAX just made new all-time highs. Yes, we are very, very extended on the upside. But I have to say, well, let me just insert the RSI here. I haven't it here. It's later relative strength. 14 probably is a good way. It's not even high. This is not high. I would be surprised, to be honest. And why? Well, because we saw a very long consolidation of weeks now. We just broke on the upside above 16,000. So right now, I would say, well, there's a projected target right now. Let me put it that way. Projected target is here, the range we just put in. So here, and then we duplicate the range. And we have a first projected target on the upside. I'm sorry, that's not good. That wasn't good. I'm gonna put it that way. Shorten things up here. So to project the target, you just duplicate the breakout here. And then you have a first target on the upside. Which I right now wouldn't like to trade. So I want to trade the breakout and initial immediate momentum. And again, we had the bank holiday yesterday, so very thin volume, which means we have a very good chance to go into squeeze mode, let's say. And also the DAX is not very positively correlated to tech stocks in general. So usually having a look at the S&P 500 is a better way here. A more positive way to look at it. We have room to go on the upside. So as long as the S&P continues to move higher and here put in further momentum on the upside, the more likely it is that the DAX will continue to trade and break 2 new all-time highs. And by the way, in the current environment, you just don't want to be long. I'm sorry, you don't want to be short this breakout higher, 2 new all-time highs, because here really the sky is the limit. So like you don't know where it will top out, but there will be clear signs of a topping out process. So you will see once the momentum starts to shift, if you go for a trade. This is also something I probably want to throw in here from a pure trading perspective. Probably a good way to good time now to make this a topic. You have to know which trade you're in. If you don't know the trade you're in, you have trouble because you don't know what you want to see once your thesis changes. So put differently, if you say I see the break higher here, then well, okay, the break higher, and then what you plan to trade? You plan to trade the momentum. Okay, fair enough. Which time frame? So you're trading here the momentum on the upside on a daily time frame. So now you're seeing the market breaking out, seeing momentum, making higher highs. There's a clear progressive move in direction of this overall trend. And so now, well, when does this change? Well, it changes once. Let me just see if we have a perfect example here. Something like this, probably here. Something like this. This is a change in character. So there's clear momentum on the upside for whatever reason. Let's just assume here that we have the breakout. We have to close higher above that level, and then we see this massive push higher, and then we rerun, and then you see we trail higher. There's still this move higher, and we are not making new lows, but there's some just wicks on the downside, yes, but they don't penetrate, they don't break below the lows of the day before. And here, this candle, this is the candle in this regard. This is changing the character, because there you have the break below this last candle. You see it already here, and this is once you exit the trade if you play the momentum on the upside. And this could be true now for this play here on the upside. So doing this, it's like you trade the momentum, you stay with the trade, the trend or momentum, as long as the momentum is given, the thesis is correct. You trail the stop based on the low of the day before, and you take out the trade once this candle is breached. As long as you make higher highs and do not penetrate the low of the last candle here below, well, you can stay in the trade and play the momentum. But once the momentum diminishes or the momentum decelerates, it's a change in character, you take out the trade, you wait for the next setup, or you look for the next market to play then in this regard. And this is, by the way, also a good way to say once or when is the time to change, or once there is a character change in character here in this regard. So I think we had a clear pattern between 15,700 and 16,000 on the upside, and then there was the question: do we top out, break lower below 15,700, or do we break higher? Well, obviously we break higher, and then we take it from there. And we play as long as the momentum is on our side and our back, and we can expect the market to make higher highs in this regard. I just hope that this answers the question. That's it from my end. So I just hope you enjoyed the webinar. So it was about inflation, but we made also the current environment a topic again. So right now, especially yield sensitive stocks like the Nasdaq are flying. The Nasdaq is flying due to the fact that the Fed is obviously expected to cut rates. Let's see if this changes with the wording used, rhetoric used from Powell already today. So we have the speech. I wouldn't put too much emphasis and expectation into this, but it's something to keep in mind. It could trigger some kind of volatility. Next month, we have the Fed. Let's see where the dot plot comes out, what the market is playing. I'm not really seeing the dots coming significantly lower, but if we continue to diverge massively here, well, we will see who is right in the end. Most likely it will be the Fed because they decide at the end, but probably they will throw in the towel and make sure that they correspond with what the market is saying and expecting, especially economy-wise. And that's it. So we have to keep a close eye on these expectations, inflation expectations. Right now it's cooling down, but this trend over the course of the last month won't continue. And now it's interesting to see whether we get to see some kind of change in regards here to the expectations around the target rate from market participants in the futures market. And now have a nice weekend. Enjoy yourself. Keep an eye on the S&P 500, and if it holds the gap, and all the best. So talk to you again next week. I really look forward to it.